This video looks at two learning objectives from Chapter 11. The first deals with revision of an estimate related to property, plant, and equipment or intangibles, and the second deals with error correction. These are topics that we looked at briefly back in Chapter 4. So we'll start with learning objective 6, which is to explain the appropriate accounting treatment required when a change in depreciation, amortization, or depletion method is made. Changes in estimates are considered fairly ordinary occurrences, routine occurrences. There are so many estimates that underlie accounting measurement, and the whole definition of an estimate would be to say there's a lack of precision. So sometimes later information will come up that will allow a company to refine or revise an estimate. So calculation, depreciation, depletion, and amortization rely on estimates. I think the word that we emphasize here is the change is handled prospectively. We just move forward with the new information. Prior year financial statements are not restated. There should be disclosure if the effect of the change on net income is material. Although, to be honest, in practice, I have rarely seen those disclosures. If a company changes their method of depreciation, depletion, or amortization, if, for example, they went from an accelerated declining balance to straight line, a change in method is considered a change in estimate. But again, that would be, I would say, a very rare occurrence. So we'll look at brief exercise 711 to illustrate a change in estimate. So brief exercise 711, we have Robotics Inc., which in 2011 acquired a manufacturing facility for $12 million. $9 million of the purchase price was allocated to the building. So we have a $9 million building, and the company used straight line depreciation, 25-year useful life, and $1 million residual value. In 2013, the estimate of useful life and residual were changed to 20 years and $500,000 respectively. So we're asked to compute depreciation on the building for 2013. See if I can get a little more room here. All right. So initially, we had a building cost $9 million, $1 million salvage, being depreciated over 25 years. If you do the math on that, that's $320,000 per year. Remember then, they depreciated it over 2 years, 2011, 2012. They make the change in 2013, and they would make the change using the new information. So 2 years depreciation have been taken, which means total is $640,000. That's the accumulated depreciation, which means that the book value remaining or undepreciated cost would be the $9 million minus that $640,000. So in other words, they've got remaining undepreciated cost of $8,360,000. That's the remaining book value or undepreciated cost. In a revision of an estimate, all they're going to do is take this revised undepreciated cost, subtract the new residual value, which is $500,000, because we're still doing cost minus the residual value, and we have this allocation base remaining of $7,860,000. That will be allocated over the remaining years of useful life. Remember, they revised it to 20 years total. You have to read that real carefully how it's written. they've already had 2 years service, so that's 18 years remaining. They had 2011, 2012 are gone. It was 20 years total life, so there are only 18 years remaining. So we divide that 7,860,000 by the 18 years, and the revised depreciation is going to be not an even number, 436,667. So that would be the 2013 depreciation. And the depreciation expense moving forward over the 18 years. So notice if we look at what this implies or what we get from this, initially the company was depreciating over 25 years, larger salvage value, depreciation $320,000 a year. As a result of the shortening of the useful life, as well as the lowering of the residual value, as they move forward, they're going to have to play sort of catch-up depreciation. With the wisdom of hindsight, they should have been recording a larger depreciation expense in 2011 than they did, but we don't go back and revise those financial statements. We simply move forward with our new revised estimate. And again, this is a very common occurrence. It's just routine. So as I had said before, unless it's a material effect, companies will not even disclose that they've made this change in estimate. Moving on to the appropriate accounting treatment required when an error in accounting for property, plant, and equipment or intangibles are discovered. When we talk about an error, this could be, well, let's go to the next slide and we'll see how we define an accounting error. An error could include computational errors in calculations, a mistake as to whether an expenditure is a capital cost or an expense. That error could be inadvertent, and again, just a mistake, or it could be, if we think about the famous Enron case, an intentional error in which the company recorded expenses as capital costs. So by putting expenses in an asset account, they were able to increase their income. If an error is material, the previous year's financial statements must be retrospectively restated. These are any financial statements that are presented for comparative purposes. So any account balances that are incorrect are corrected. And if the change affects income, then we would adjust retained earnings. And that's what we call a prior period adjustment. Remember, if the error was made that affected prior year's earnings, we're unable to go in and correct the revenue or expense numbers because those accounts have been closed to retained earnings. So our adjustment is made directly to retained earnings with a disclosure note to describe the nature of the error, the impact of its corrections on the income statement, net income, and earnings per share. So, for example, in the Enron case, I forget the total dollar amount, but what should have been expensed was recorded as an asset for their, they had an asset, and it was many, many millions of dollars. They capitalized their line costs. Those costs should have been expensed, and income in prior periods should have been lower. So to correct that, they would restate, and I keep saying they would, saying Enron, I'm sorry, it was MCI, or WorldCom. What they would do then is take the dollars out of the asset account, because those are permanent, say, well, capitalized in error, and they would debit retained earnings. Remember, retained earnings would have been increased by income. We're decreasing retained earnings, recording a debit, taking those dollars that inadvertently went to that were not expensed and should have reduced net income. And so that's what we call a prior period adjustment. We hope they are relatively rare. We only have to do this if the books have been closed. If they haven't done if financial statements have not yet been prepared and they find an error that occurred in the current year, company would just make a correcting journal entry to fix what was wrong before the financial statements were issued. So we're really talking about when we discover a mistake that was made in a previous year and it's necessary to restate those prior years because, again, financial information is used comparatively. It's not used in isolation. So this includes a very brief overview of change in estimate and correction of an error.